Viens, du. Viens, du. Veikia?
O mano veikia?
So let's switch to English. Good afternoon, everyone. Whoa. Nice to see you all here today in our first event, which we're holding as Reporta with several great experts in the field. And maybe biggest thanks for this event happening today goes to Auditors, who a few months ago decided, oh guys, there is a need probably, and I think that I can manage to do it, and I believe you did it. You managed to invite so many great experts from legal side, regulator, market participants, Fintech Hub. So let's hope that today is going to be fun. Anything you want to say?
Oh, thank you indeed. The idea came actually thinking about you, Vitalia, because you are all about AML, and I thought, okay, there's so much attention on the AML topic, but if we look at the fintech organizations, it's not only AML that we have to deal with. Regulation is very, very broad, and I would compare it like if you have children, you have to take care of all of them, not just one, right? So I thought, okay, maybe we should do a little bit more awareness on that topic. And then in addition to that, I saw that Bank of Lithuania is also raising the awareness and performed some analysis on that. And we're reading in some reviews and some penalties also coming up. So I thought the facilitation, the discussion between the regulator and the fintech community is absolutely a must. And I hope that this event is just the beginning where we can deep dive into some more topics within the risk management arena.
Indeed, I agree with you. And I think even in our discussions in a small room, we were talking about how to prepare, what to tell to you, what to share right now today. And we just found ourselves in discussion, in a panel discussion. So I hope later on it's going to be a lot of information going to you. And what's waiting for us today? We're going to have 4 nice presentations, and afterwards, a panel discussion. I would like you kindly to think about the questions. If we have time, we will ask every participant after his or her presentation. If we are a bit short on time, I will save it. I will ask you to save the questions to the end, to the panel discussion, and I will be going around and asking questions. So those whom I know in person, be sure I will come and ask. If there are no questions on the field. So anyway, without further ado, I would like to invite on stage Denas, who is coming as with a head of regulator. He will be sharing his view on the risk management field. And yeah, Denas.
First, I would like to introduce myself. So as it was said, I'm from Bank of Lithuania. I'm currently the head of payments and electronic money institution supervision. So our job is basically to manage financial risks and our prudential risks, such as safeguarding. If I can put, so what I want to pay your attention to is that to the risk management as such, which is quite a broad topic, and to show our current policy and probably some issues in that regard, and what we see in the market so far. So what is risks? First question is, and according to different risk standards, it has a bit different definitions. But overall, it's basically a risk which is the effect of uncertainty of objectives. So it's not actually the risks as such is not defined in the regulations. You cannot find what actual risk. It has different categories such as AML, you have safeguarding and such, you have bankruptcy, but it's strange that regulation doesn't say much about risk as such. And what we want to say that, if you look at risk management as such, you shouldn't start maybe at regulations, but you should start at risk management standards, which is basically a methodology how to implement some processes in your organization to manage those risks. So if I was a financial market participant, I will start with that. And what we would like to see, that you should make that an ongoing process which is beneficial to your organization. It sounds quite broad, it sounds without basis, but it has to be beneficial, because otherwise if we do it for regulators' wish, so it's no purpose on that. Some risks are controlled by regulation. So if you are from EML side, you know that you have to have QIC, which is internal control. You have to have enhanced due diligence process. So it's basically some regulators decided that that's needed to be regulated. So we put those regulations in place and internal controls in place. So if you see, the regulated topics are AML, operational risk, business conduct, credit risk, over-regulatory risk, but there is a broad spectrum of risks which are not really regulated, but we are important. And as we see currently, well, banks in America are going bankrupt, and they didn't manage their interest rate risk. Was it a fault of regulators? Maybe, but some fault goes for the banks as well. So what we're trying to do now, pushing the idea that other risks are relevant and you should take into account other risks as such, even though we are not regulated as such. But what does the current regulation say, let's say? So it basically says that you have to have 3 documents for your risk management processes. So it's a risk management strategy, which is approved by supervisory body. It could be in EMI, PI sector, it could be the board of management, or it could be the board of shareholders. You have to get quarterly risk maps, which is submitted to the management board, and you have to have annual risk reports. However, the issue is, what does it mean? And I have to admit, current regulation doesn't say much about what it actually means. However, we have mentioned some things in our Dear CEO letters, but it's still quite ambiguous. What does it actually mean? So I tried to put our perspective, what we would like to see, and I like to look at it from the management board's perspective. If I was sitting on a management board in Fintech, so I would like to see a broad spectrum of data reports which are beneficial to see how organization is actually doing in terms of risk management. So risk strategy is something which is a high-level document, but it actually defines some indicators for each type of risk, maybe defines the risk appetite of yours. If you're going for high-risk clients in AML, probably you have higher risk appetite, so you have to maybe define that, but you also have to define the mitigating measures to control that, and maybe a limit where you see that, okay, it's going out of control, so we need to do that. So it should give you a strategy where we're going, but still put some limitations where we have to stop, maybe, and do something about it. And actually, it's a good idea to define different responsibilities for different roles in your organization. Something should be the chief risk officer's duty, but it's probably also compliance officer. It's also other employees which are actually doing the work in our organizational. So our risk maps and annual risk report should maybe monitor what's actually going on in the organization and monitor those risks and indicators which you put forward. An annual risk report should, if I see the report, so how the organizational, what it actually did to prevent risks, what risks materialized, what measures were implemented, and what we have to do more to prevent that. It sounds very high level, but the regulation is very high level at the moment. So from policy perspective, we want to see that it's, in principle, it helps you, it's a helpful tool to monitor the risks. So, as I said in the slide, it's principle-based at the moment, not content-based. So we don't go to the content and we don't regulate what kind of indicators you should put forward, what kind of, I don't know, risks you should take account. We say it should include all the risks relevant to your business model. And we know in fintechs, business models vary from one spectrum to another. It's not like traditional banking where you have credit risks, probably number one, liquidity as well. It's a bit different here. So, noting that we did the infamous risk management analysis in fintech sector, and it actually included not only our regulation from IT sector and risk management perspective, but also we put in analysis the risk management standards, which was the basis of our analysis. So, as it could be expected, as it's not regulated, and we put the best practices in our analysis as the basis for the analysis, 62% of institutions did quite, say, badly in that regard. And what we saw, it was that the main issue was that there was no such documents at all. So when you look at the market currently, the major problem is that the market participants do not have any documents, any processes in that regard. But not all of them, but many of them do not. And as we look at the good practices, preparing such documents as such are good practice at this stage. So yeah. So as we look at our analysis and inspections, we look a bit in that regard. We do not enforce it. We don't put enforcement measures as of yet, but it is quite ambiguously regulated. So when we look at risk management strategy, we see that it's usually prepared after we noticed that we put the inspection plan forward. So that's the first thing we notice. It actually is not approved by anyone, so it's usually just written for the purpose of being. So, and that's quite strange. And the more interesting part is that when you look at the organizational structure and the responsibilities put forward in those documents in terms of risk management, it doesn't coincide at all. So basically, it's like a basic template for, I don't know, risk management policy, which is not, it has nothing to do with the institution itself. And for instance, we have many fintechs which came from UK after Brexit, and we are very dependable on parent company, IT systems, for instance, outsourcing, even human resources. We are dependable on parent company. However, in risk strategy, it's nothing mentioned about it, and it's high risk when you are all your functions depends on parent company, and you have any strategy. How do you manage those risks, and what responsibility is shared between you and the parent company? That's, if something happens, nobody knows who is responsible for what. So risk maps and risk reports is usually the same. It's usually not approved by anybody in the management board. It doesn't correspond to the business model, and so on. We also did the internal control analysis. It was a bit, the scope was smaller. It was only 5 institutions, while risk management analysis was 80 institutions. And what we see that the institutions which had a good organizational structure, properly defined roles, functions of management body, proper governance arrangements, defined internal controls, defined responsibilities, we usually have better risk management, at least policies, because in these analyses we do it, we analyze the documents, not the processes as such. As we go to the inspections, we will go to the processes itself and we will see how it goes. But as far as the documents goes, if institutions have good governance documents and policies, we usually do have quite good risk management documents. But if, for instance, if there is quite bad governance, it's usually the same problem. There is no documents at all. It's like we don't know what's going on there. So yeah. So and for the end, I think what is important, and I has already stressed, we usually see that good internal and governance environment leads to good risk management environment. And usually, when we, as a regulators, we have meetings with senior managers, with CEOs, country managers, and if we are quite positive and serious about regulations and internal controls and the importance of risk management, because we understand that if something happens, their business can go, at least we can be revoked from the license. So if there is a positive attitude from the management, it usually goes throughout the organization, because it sets the tone for the rest of the employees to do it properly. Also, it's important because as a regulator, we see that if you have 3 employees in your Lithuanian entity, that your payments value goes to like millions, hundreds of millions. I don't know. It looks suspicious to us. So how do you manage your risks if you have 3 employees and your payment volumes are quite large? So it should go proportionally. If your payment volumes goes up, your employee levels should go up as well. There's no magic formula, probably, because it depends on your business model, it depends on your internal processes, it depends how much of your functions are outsourced. Many things depend. But we see that you need adequate and quality people, which is hard to do these days. And that should lead to the development of risk management competencies at all levels, from the board and managers to employees. But it all starts from the top. So that's my main message today, I guess. Yeah.
So thank you, Denas. Any question from the audience? Anyone want to ask something? Yes, we will share. So save your cameras. If no questions, I will ask questions later on because I have many of them. And I totally agree with you that risk management starts from the very top. And I always say that risk management is an umbrella which saves all the organization in general. So let's move on. The next speaker we're going to have on stage is the co-founder and partner at WALLESS firm, and Jonas. Welcome on stage and share your...
Well, thank you, Vitalia. Good afternoon to everyone. Well, it's a pleasure to speak today here on the topic that is very relevant, we all agree. But to begin with, so I'm a lawyer, and I said to myself that I will argue for the industry in this case, because we heard the regulator has many expectations, but I think the industry has many challenges. And I will look at the same topic from a slightly different angle, specifically from the kind of regulation angle. And let's see how we understand the legal requirements, and let's see how many room for interpretation we have here. So I think the situation that Denas has described, that no e-money institution or payment institution has actually passed the survey to the level of the expectation, was predetermined. It was predetermined because, well, definitely the industry has a challenge here. And the challenge is because, unlike other areas, risk management regulation is minimal. We will talk about that in a second. Requirements, even if they are not always clear. And even amongst the speakers groups, we had hot debates what this or the other document might mean. And on top of that, of course, it's even more difficult if we have some inconsistencies with the legal requirements, the guidance, and the expectations. So let's look at the requirements themselves. And if we look at the risk management, specifically risk management topic, we find just 6 clauses in the relevant resolution of the Bank of Lithuania board. And as Denas has already mentioned, it starts from the risk management strategy. The risk management strategy and the risk management framework must cover risks that are specific to the institution. And there's just a few kind of examples. They must cover the settlement risk, the liquidity risk, the operational, AML, compliance, market, counterparty credit, concentration, and others. You have to decide which ones are relevant. The person responsible for risk management, of course, there has to be one appointed, must report to the management board of the institution the quarterly risk maps and also an annual risk management report. The regulation also says that the institution must approve risk management procedures. Employees should report to the responsible persons about deficiencies and breaches that they discover during their kind of daily activities. And the institution must also assess on a regular basis the risk management and internal control framework and its efficiency. And that's basically it, what we have from the regulation. And then it's a matter of perhaps your creativity, how you develop your risk management framework. And then the second question is how detailed it is, how efficient it is, and what is the quality of this process. I was actually surprised to see a reference to this UK standards in the official letter of the regulator. I was surprised because it's not a legal act, it's basically a book, and on top of that, it's not even easily publicly available. So, of course, I have to admit that certain areas, they are regulated in more detailed. We all know the AML requirements, we all know the information security regulation, safeguarding capital sufficiency, even outsourcing. But on the other risks, we basically have nothing coming from the regulation. So it's actually up to the institutions to develop their risk management framework, and it has to be described in the internal documents because there are not so many other sources. And of course, for that, the institutions need experienced risk management experts. And we all know that it's not that easy to find one in the market. So again, perhaps these are the kind of reasons why we have the situation the way we have it. So it was already mentioned about the risk appetite and the risk limits. I would say that it's perhaps a separate science, and risk management experts can speak about that. What is risk appetite and what are the indicators and what are the limits? For me, it doesn't look like an easy exercise, and I've seen a couple of risk management strategies, and they were so different, like totally different approach. I'm not even speaking about the risks and the indications. I think one of the immediate questions that arise is how detailed that strategy should be. Of course, we have no guidance, so it's up to the institutions to decide. Then it's often a question how to quantify risks and how to measure them. And if you think about, I don't know, compliance risk, what could be the appropriate limits for that? And again, we've discussed maybe a number of fines imposed by the regulator, but it looks like it's maybe too late, or a number of complaints, or I think I've seen somewhere an indicator that was something about the action items of the remediation plan that haven't been implemented. So I think that this can go far, but the question perhaps is when this exercise is a theoretical one and when it becomes really practically useful. And if you ask me if the requirements are the same for startups and mature institutions, so the requirements that I've shown, they are the same. Of course, the relevance of the risks perhaps is different, and the framework will be perhaps different as the institution grows. So, despite that we have very little regulation, we heard that the expectations of the regulator are higher, and it's not just the risk strategy, not just the maps, not just the annual report, what is expected, but I think it was mentioned in this one-pager that the regulator expects the strategy and the policy as separate documents. In addition, there should be procedures, again, in other kind of level of detailness. And we also heard about the incidents register, the risk register, the implementation plan, the communication plan. And I'll stop there because I don't know what is the communication plan, to be honest. And we had discussion, and maybe we can continue on the panel because we've heard different interpretations. So taking one step further and not just focusing on the risk management, but if we look at the internal controls, which is like a way broader topic, I could continue for long, but I just wanted to mention a few policies that are not that oftenly seen. And one of them would be the policy for assessment of the managers and key function holders. We kind of know that certain managers require a fit and proper approval of the regulator before they can start the office, but actually the key function holders who are not subject to the fit and proper approval by the regulator, they have to be assessed by the institution itself, and there should be a policy for that, although there's no explicit legal requirement. Well, the conflict of interest, I think, is a very kind of relevant topic. And again, I'm pretty sure that not many fintechs have a conflict of interest policy as such. The remuneration policy, again, the management should not be incentivized in a way that the risks are neglected. I believe it's, again, a very relevant one. The whistleblowing policy, perhaps no one has ever thought about that. But again, as we saw in the legal requirements, the employees must notify the relevant persons if they come across certain breaches. And there's also a separate law on whistleblowing where you have to basically report if there are cases of public interest. So this is again a separate topic, but just maybe to add a few to this list, most of the fintechs are surprised to hear from us as lawyers that there should be working regulations of the board that set the procedure, how the board is operating, how the meetings are convened, who can propose items to be included in the agenda, how the decision-making works, and things like that. People are somehow still surprised that it's not okay to take board decisions via Slack or other means, and that there should be minutes, and actually there are certain requirements what those minutes how they should look like. Perhaps the last that I wanted to mention is the new products governance rules. Again, not very common, but I would say very relevant. And in fact, it's not that someone all of a sudden decides to launch a new product. There has to be checks how the new product must be assessed from different angles before it can go live. So that was about the documents. But as it was rightly pointed that the risk management starts from the top. And I think a very kind of relevant question to start with is the effective management. And here you see just the minimal requirements, like the bare minimum of the positions that have to be in a fintech company. And well, the supervisory board, we all know it's optional, but I will talk in a second, is it really optional? The 3 board members, one of them has to be responsible for MEL. We have just discussed before the event that maybe a CRO should also be a board member. Why not? If we wanted to enhance the overall kind of awareness of the risks, not just one specific risk. Well, of course, the CEO, the deputy CEO, or the country manager, it's an optional position. The MEL officer or MLRO, again, a debate. What is the proper wording for that? A compliance officer, information security officer, internal auditor, data protection officer, outsourcing officer, risk officer, and someone responsible for implementation of international sanctions. Someone has to be assigned this function. The MLRO can take that function, but it's not automatic. There has to be an appropriate internal decision to appoint someone responsible for the sanctions. So, and even this minimum requirements list seems like rather clear, but if we look at the supervisory function, in most of the fintechs, it is within the shareholder. In theory, the board could take the supervisory functions, but there are 2 conditions for that. First of all, the CEO must not be a board member, and the other one is that more than half board members should be independent, meaning that they don't have employment relations with the institution. Well, if these conditions are not met, then the supervisory function rests with the general meeting of the shareholders. But let's think about the situation which is very common, that a Lithuanian company is owned by a single parent, And the parent is represented by a single person who has no knowledge or experience about the risk management. And then this one person adopts decisions like approving a risk management strategy that defines the entire framework. So I think it's really difficult to expect efficient risk management when the supervisory function is not actually in place. Another relevant question, should the managers meet specific requirements? Well, if we look at the legal acts, there are no specific requirements. And we see now that the regulator tends to challenge the candidates now. But again, since there are no specific requirements, it's again another area for different interpretations and at some point perhaps even disputes. Another question about the country manager. Again, from our experience, should the country manager be subject to the fit and proper approval of the BOL? And the answer perhaps depends whether he is officially a deputy CEO, then yes, he would be subject. Even if he is not a deputy CEO, I would say that if the country manager pretty much has the responsibilities of the CEO, perhaps it would be logical if he is subject to the fit and proper approval. Jumping to another topic, and just to briefly touch on the 3 lines of defense. It's perhaps a fundamental concept in the risk management area. And again, no regulation, so it's more like the concept developed as best practice. And I think, again, there's a lot of confusion around that. We've seen the latest kind of guidance that finally said that MLRO is actually the 2nd line of defense, which was good to see an answer. But I think the issue is that in reality, MLRO usually covers the 1st line of defense functions as well. And if you think about Fintech that has just one MLRO at the start, I think it just cannot be otherwise. Then again, one of the questions, can the MLRO and the compliance officer be the same person? We know that the Bank of Lithuania sort of expects that these are different people, at least at the licensing stage. That comes from the DRCO letters. But on the other hand, the recently issued compliance guidelines says that these roles can be combined as they are both 2nd line functions if there is no conflict of interest. But on the other hand, I would argue that perhaps the compliance function should also oversee compliance in the EMI area. And if it's the same person, then definitely he or she cannot oversee himself. So again, this is just to illustrate that the understanding is different and that the interpretation is not always easy. And perhaps to conclude on the 3 lines of defense, my main point is that as long as it is the concept of best practices and not the legal requirement, the sanctions cannot be imposed for the not following of best practices as opposed to the legal requirements. And that is actually what suggests the courts, that well, administrative liability is only possible if there is a mandatory legal requirement. I'm not suggesting to think about the litigation instead of thinking about risk management and how to get it right in your companies. But as a lawyer, I would like to have the rules clear from the outset. to avoid any misunderstandings. And perhaps, again, it should be in the interests of the company to manage risks because, well, the business may discontinue if certain material risks materialize. This is actually the last item that I wanted to touch. Again, in practice, the area that raises questions. And if a fintech admits that it needs a CRO, then the next question is, can CRO be outsourced to the group? Because, as we know, it's okay to be lean. And perhaps the answer is yes, it can be outsourced because it's not prohibited. But you have to think, what if the main outsourcing partner of the company is actually the group? So would that be efficient? Also, I wanted to stress that what cannot be outsourced is actually in the manager's functions. And for example, the board members under the Lithuanian corporate governance rules, they have to always act independently and in the interests of the company they represent. So no matter what the group says, no matter what the shareholder says, the management should be acting on their own and, again, in the interests of the institution and not the shareholders and not the group. Should the CEO have an employment contract? Well, the answer is yes, because that is required by the company law. Should the AML responsible employees work under employment contracts? Again, we see that the practice is different, but well, the answer perhaps is yes, because that is specifically required by the AML laws. We can discuss what is the rationale behind that, but the rule is as it is. And perhaps last, but definitely not the least, can key function holders work part-time? In theory, perhaps yes, but on the other hand, if these are continuous functions that have to be ensured all the time, it's a question. Maybe it's not the part-time work, but it's a team that is needed. So that brings me to an end of the presentation. I think we'll continue the discussion, but maybe just a few final kind of words from my side is, even if the regulation is not very specific, even if it is not clear, well, you cannot do nothing. You have to look for the answer. You have to look for experienced personnel. You have to look for external advice. You have to seek guidance from the regulator, because the ignorance is not a good excuse when it comes to liability. So, thank you.
Thank you, Jonas, so much. And probably indeed, too many questions went from your speech, and I was thinking, listening to you, you listed a number of people we would expect to see in the mature and well-established EMI. I'm looking now at Denas, and I was like, do you have a list of policies we need to have in EMI, or at least what would be the good thing? So maybe that's homework for you to do, and maybe to share with us about what we can do. Otherwise, yeah, you will do. Okay, great. Because listening and thinking, okay, well, if you are a bank, yeah, you probably have a pure list, a huge list of what you have to do and which areas to cover. When you are a startup, a new company, so it's more complicated. And yes, resources coming to finding right people in the right place, it's a very, very tough question. And I think I've seen that fighting with auditors all the time when trying to develop risk management framework from scratch. That you cannot make a template and adopt it to everyone. So every time when we are doing something, we try to go as deep into the company and develop it to the company. Take all the aspects of that. And today, auditors will come and show some examples how to do it, how we can see, how we have seen it, right? Go, come on. Come, come.
Thank you so much. Ooh, this is loud. Thank you. I think it is time that we talk about not if we should do risk management, but more how we should do risk management. And I think also, I don't really know the reasons why risk management is a little bit like on the side from other things. Maybe it's because electronic money institutions, payment institutions, they do have less risk compared to the traditional banks. And maybe, you know, we began thinking, well, there's less risk, so maybe we will do less work. And then there's AML, so we are so busy with AML, so we focus on that. And it could be, but I think we are coming to the times where regulators looking for more maturity in the industry, and we have to step up. So I think sharing the best practices and patching the gaps in the regulation, bringing more clarity from the regulation point of view, put that together, and I think we'll have some progress, right? So coming to the presentation, everyone will probably walk out today from this meeting that agenda for risk management is really not that small, right? There's a lot of things to do. And then we are talking who is supposed to do these things in the organization. And many times we see that if it is done in silos, if we manage risks in silos, it becomes very complicated and difficult to achieve a result that gives value to the organization. So I do tend to speak about enterprise risk management. It does help organizations to have an umbrella, and someone in the organization has to see the big picture from all risk perspectives, connect the dots on different risk types. As Denas was speaking, right, there are regulated risks, operational risk, credit risk, but we do have to think about other risks, assess those risks, understand the levels, the controls we have in place, and then prioritize our activities, how to deal with that. If we don't do this, we're basically in the dark. And if we are in the dark, you know, there's this saying, how do we get somewhere to the destination if we don't know where we are? So we do need to know where we are, where we stand with risk management, what's our profile, right? So all these things listed here is just the tip of the iceberg, but the agenda is not that small, right? So if we do build enterprise risk management, even for a smaller fintech company, there's quite a few things that need to be working. Everyone mentioned tone from the top. Tone from the top, if that is not in place, we basically have a tick-off exercise. Someone in the organization is mandated and asked, can you please make sure, just tick off these assessment exercises, send it to the Bank of Lithuania and make it go away. There's absolutely no value in doing that, other than just maybe having a license in place, but tone from the top is the key. And I do look at the Bank of Lithuania for making sure that the right people are on the top and that they are steering the ship in the right way. It does help the employees because there is no motivation. If the top is not interested in the result, why would I really stress myself to deliver a very good result? So everyone is interested in having the right tone from the top. Governance, I mean, just to put it in a simple terms, we do need to have clarity who's doing what in the organization. Again, if in silos the policies are written by different people, we see that it is becoming extremely difficult to have a fruitful discussion in the organization because there's just one policy goes one way, the other goes the other way, and there is no clarity who has the ownership and who is supposed to assist, who's supposed to be consulted, who is controlling it, and so on. We rarely see a risk management plan in place, and I do encourage to have that if someone still thinking should they have it, because first of all, you set the tone for entire year. You say, this is what I'm going to do this is what I'm going to do that, and then you share with other second line of defense employees, because then you can coordinate when you're going to do the EVRA, when you're going to do operational risk assessment, information security assessment, business continuity testing, and so on. So it gives efficiency to the organization because everything is working much more smooth. Policies. The missing policies is probably the first red flag to the Bank of Lithuania. Having a policy but not updating and not executing on it is a second red flag, right? So having an inventory of all your policies and the schedule when you're updating those things, and especially when you're doing the changes, if you're changing the core banking systems and so on, you need to come back to the policies. Data is also key, because without data, we will be autists. We will be dreaming about risks, not actually assessing it. And you will probably agree with me, data is extremely important in risk management. So we have to make sure in the organization we have registers, and there's actually something going into that register. How many times we see that the register template is there, but it's absolutely blank, or maybe one record in it. So you have no data, and then it becomes very difficult to work and do any assessments on that. Tools are also important for fintech companies because you are small and it takes a lot of time to develop something. So you do risk assessments and you do business continuity testings and you have to work with outsourcing and other things. So you will spend a lot of time building those things. If you can lean on something, if you can buy something, if you can take something that is already there, it helps. And also tools help you navigate. It's like a process that becomes in your organization. So I would look for that and ask myself a question, what tools I need and do I have them and where can I get them? And trainings go without saying. In many Bank of Lithuania inspections, we see that trainings are not performed, and it seems like a small thing, but if we have policies in place and we do all these things, but there is no trainings in place, that means we're not building risk management culture in organization. That means there's employees in the company that have no idea, no clue why we're doing risk management and how it works and what is their role in that, right? So it's just certain things, it's quite a bit, seems right, but connecting all these things is a start where you can build a system that actually works. I cannot talk about all tools and cover in 15 minutes, but I decided to stress the importance of the assessments because there are so many assessments, right? I mean, we do AML assessment, we do operational risk assessment, there's so many. And do I know if I do them all? Maybe I need more. Maybe I do too many, right? So one advice that I could say is that usually you start with the long list, which means what are the risks that my organization is facing? What are the potential risks that I'm facing? So when you list those and then you say, these are the relevant risks to my organization, then basically you come up to the short list and then you are able to say, okay, these are the risks that are relevant, that we are facing, we recognize that, and then we can assess them. And how we do that? So then you can have templates and tools in place, and you can schedule those assessments. It's a great way to actually understand whether you are within your risk appetite, right? So there's the reason why I put the risk appetite in there, because it's there for a reason, right? So risk assessments, they tell you where you are, what risks you are facing, and then you can put them together into nice risk maps. And as you do that, you have continuous improvement. So all these things put together were quite nice, but again, you need to have a big picture in the organization, not work in silos. An actual risk assessment and having a common methodology is key. What we see is that sometimes different employees responsible for different risks, they develop different methodologies. And if they don't talk to each other, that is a problem. Because if you have completely different methodologies, then you're working with kind of oranges and apples, probably, to put it together. And it becomes difficult to explain to the board what risks we are facing and which are the highest risks and which are the lower risks and so on. So putting a common methodology, then you can have deviations. Of course, there are different inputs in AML risk assessment compared to operational risk assessment, but you will probably have to deal with risk factors, you will have to deal with inherent risk, You will have to deal with controls, understand those controls, assess the controls, and then you come back to residual risks. So that is the foundation that you work with. And again, data, rationale, why you think such way. In many cases, we just do we put a number. I think this is a 4, I think this is a 3, and our risk level is maybe a 4 or 5, but there is no explanation why we think that way. What are the systems that are contributing to or within that risk, right? Connecting to that risk. So that is important. And also, of course, to make sure that it is actionable. So every risk assessment we do, as Denas said, if it's not reaching the management, it's not actionable. That means we identified the risks and it's just laying there. Nothing is going to happen from that. So pushing that on top. Just throwing some examples. The first thing when you work with risks is identifying what risks you are facing. Again, there are different methodologies. You can use SWIFT to help you kind of massage the brain, but also it is important to engage other employees from the company. It cannot be an exercise of just CRO. It simply cannot. A CRO does not know all the risks that the organization is facing. It is different employees from different areas that face the risk and deal with that. So we must ensure their participation in the risk management process. They need to spend time in this and give input. There's no other way, right? So again, and this is just an example, and then when you come to controls, one of the common mistakes we see make is that the control is just assessed subjectively. I think it's working, or oh, I think it's great. No, you know, it's not the right way to assess your controls. You have to put a little bit more thought into this. Like maybe one of the ways is actually ask certain questions. Is the control documented? Has it been tested? Is it optimized? And so on. So these things at least help you to think about the control more deeply, challenge the control itself, document it, and when Bank of Lithuania comes, I think it's also a good audit trail, a good proof that, look, we thought about this. This is our thought process. So that's probably one of the things that I could recommend. Now, what are the challenges overall with risk assessment that we face? Again, as I mentioned, different owners, different responsibilities, and that creates a chaos. Lack of tools, for sure. Lack of process, because again, in my next slide I will speak, there are certain assessments that is not just that I take the assessment and do it, but it's actually a process that you need to build in the organization in order to deliver the end result. So you have to define the process, how it's going to work. Lack of time and resources, for sure. Every fintech has that problem. And clash of methodologies, I think I mentioned, and not seeing the big picture as well. Last topic, just to touch it, because I could not, because I could not leave this out. What we see in many fintech companies is how they work with outsourcing. Outsourcing is on every fintech's agenda. Core banking systems are outsourced, identification services are outsourced, and so on. And there are very kind of, I would say, clear requirements how to deal with outsourcing. And I would like to say, first of all, that dealing with outsourcing is not a one-step exercise. It's a life cycle management, because if you think about it, there are requirements how to onboard the vendor that you are outsourcing, and then how do you know, is it outsourcing, is it not? Is it significant, is it not? So, and all that needs to be documented. You can't just say yes, no, thank you very much, and goodbye. That's not the right way of doing the assessments. And then once you have the outsourcing party, there are a number of activities that you have to do in order to make sure that it is okay to use that as a vendor. So you have to do periodic risk assessments, especially in those significant outsourcing counterparties. You have to have an exit strategy in place. So here I'm just listing some steps that are there, and as you read, then you start thinking, oh my God, there's a lot of work that I need to do. So this needs to be understood by the management, and proper resources need to be allocated in order for this to work, right? And again, this is relevant for for many, many fintech companies that deal with outsourcing. And having such tools in place really save you time because it takes you through the process. You don't have to think and create from the start. Efficient value, adding risk assessments. So very briefly, collaboration is the key. Engaging the experts, as I say, of course. I would recommend using 5-scale methodology in assessing the risks. I see some discuss maybe we should use 3. I think it's not sensitive enough, so I would recommend using a 5-scale. Consistency in methodologies for sure, and rationale, as I mentioned, for controls. It is also necessary not only for controls, it's also necessary how we identify inherent risks. In everything that we do, we must have rationale and explanation why we think in such way. This really puts clarity for you, for other employees, and also communication to the management board. So maybe just to save time, I think I will come to an end, but I'll be happy to answer any questions after the conference. You can find me on LinkedIn. And then I'm looking forward to the discussion.
She will represent internal auditor's opinion. What she did just for this event, she ran a survey among the internal auditors, and she will share the results of that survey.
Yeah. Thanks, Vitalia. Good afternoon, everyone. So as Vitalia mentioned, on a daily basis, I'm a lawyer advising fintech companies on compliance matters. But today, I have an honor to be a representative of the Lithuanian Internal Auditors Association, being a member of this association since 1918. We have conducted for this event a survey amongst our members. And our survey covered not only risk management, but we took a broader approach, and we covered 4 areas. In addition to risk management, we asked our board members about the governance, freelance model implementation, and outsourcing. We received 18 responses from our members, and majority of them were received from internal auditors who execute internal audits for the financial institutions. So let's start with the first question. And the first question covered the area of the governance. Let's start that legal acts require that managers of the EMI institutions and payment institutions have necessary competence and knowledge of the business model of the institutions they represent. However, the survey results shows that in many cases, board members lack competence of the area they supervised. For instance, board member responsible for IT security has no clue about how information security works. Another point is that board members do not dedicate sufficient time for execution of board member functions, or if they do that, they do that very superficially. Another point, which was also highlighted by respondents, is even though legal acts required, for example, to appoint a board member responsible for organizing AML implementation, they do not do. And the information flow usually is not efficient to the board members, and this does not allow to make informative decisions. In the usual case where a foreign company establishes subsidiary in Lithuania, there is a case that the board of the subsidiary only formally approves decisions that are made by the parent company. Moving to the other question is regarding governance, according to the regulation, governance arrangements shall be established according to the business model, nature, scale, and complexity of the risks inherent by the company. However, we asked our members what are the main drawbacks they see in the governance structure of EMI and payment institutions. So, in many cases, as also previous colleagues mentioned, organizational structure even not approved by the competent body. Key employees are not hired, or employees that should be responsible for control functions are not appointed. In addition to that, there are no job descriptions approved in the institution, meaning that it is not clear who is doing what in the organization. In terms of small-sized financial institutions, internal auditors noticed the lack of clear separation of duties in these institutions, or that some functions are duplicated or even are not covered within the organization. And lastly, implementation of free lines control system is not ensured in such institutions. According to the survey results, risk management is the most painful area for electronic money and payment institutions. To be more precise, as already discussed, risk management strategies or policies are not approved by competent bodies or are not updated on a regular basis. Risk assessment usually is not conducted properly, or is done in a very formal way. Identified risks and assessment results are not communicated to the top management on a timely basis. Sometimes risk limits are not set out, or if set out, they do not correspond with risk management strategy or risk appetite of the institution. Even more, no risk mapping are done across the organization, or risk management measures are not suitable, or risk incident register is not informative, and the data used in this register cannot be used for further risk assessment. Three lines model, which previously known as three lines of defense model, was updated, and which was updated in 2020. To remind briefly, the first line are most directly responsible for delivering products and services to organizations. Second line role provide assistance in terms of managing risks. And the third line, in principle, it is the internal auditor that should ensure adequacy and effectiveness of governance and risk management system. So the key challenges to efficiently implement this three lines model, according to the survey results, are the lack of human resources, or which means that too many functions are attributed to one employee, and this also could raise conflict of interest question. As mentioned previously, supervisory role played by the general meetings of shareholders also could be a challenge to efficiently implement three lines model. And lastly, sometimes the lack of support of the top management could lead for inefficiency of this model. Last point, which was covered by the survey, is outsourcing. Because especially when we have small-sized EMI or payment institution, they usually engages with suppliers to get services which are needed to provide services for institution clients. So key non-compliance which are identified by the survey is that, first of all, the high reliance of outsourcing partners. Second, that institutions fail to identify which are critical services, meaning that if they do not identify the services critical, but it is critical, they don't refer to the Bank of Lithuania to get pre-approval which is needed. Another point in this area is that auditors specified that there is no, or the risk assessment of the suppliers of this, or this risk assessment is very formal. There is no monitor and control procedures of the outsourced partners, or no employee is appointed to control the supplier. And also, in terms of the contracts, the outsourced contracts do not contain mandatory provisions, or there is no exit strategy stipulated in these agreements. So that's all from this survey. Waiting for the panel and questions. Thank you.
Yeah, so thank you all speakers, and I think it's time for panel. We are a little bit running out of time, but yeah, I will invite all the speakers to the panel, Sigita, Denas, Joanna, Audrus, and to make it a little bit more spicier, we have two additional guests. So it's Andres, board member of Fintech Hub, so please join us here, and also we have Gintautas, CEO of Paysera. So I believe you will bring more practical stuff to this discussion. Here you go. Okay. And I would like audience as well think about the questions and help me a little bit in this panel discussion. But probably I will start right away. You know, listening to all of you speaking today, I was thinking that risk management is indeed very, very complicated thing. You need to have everything. You need to have policies in place. You need to know who is controlling what. You need to have resources. You need to know how to build the risk appetite, what to put in it, right? What to do and so on. But at the same time, I was thinking that today, IML, which is probably love of my life, if I can say so, is well regulated. We know everything about that. Everybody knows what's IML in. And maybe 5 years ago, it wasn't so known. And we had many fines, we had many lessons learned. And yet we are where we are today. So the first question from me is, what can we do differently with risk management so that in 5 years, if we meet here again, we all know how to do a proper risk management without playing Tom and Jerry or playing bad guy and the policeman game, right? So what we should do? And Gintautas, what do you think? I will give you mine.
Okay.
Yeah.
It seems working. So actually, we are already doing that. We are having here a community which are sharing definitions, because definitions are really, really important. By agreeing on things and calling the proper names, by agreeing what's expected from that definition, from that process, and what maturity process, what's need to be understood and what's followed, allows us and institutions to work much more autonomous in this difficult area of risk management, because it's such thing you cannot touch, but you need to measure, you need to control that. And second thing, what I see is we always say companies lack resources. But actually in our regulation, we already have the size of the companies. The companies does not start from like 4th level of resource process maturity in having data, having a continuous review of processes, policies, and everything. Maybe we should have a little bit different regulation by the size of a company, like small EMI, who is exposing himself to a small amount of financial risk, does not need such a high controls. Because it's easy for bank to have a mother with all the framework coming and giving everything. And for fintech, which is driving evolution and innovation, starting with all this, it's really hard, and you have starting fintech very fast with small amount of financial exposure.
Mm-hmm. What do you think, Denis?
Yeah, I think it's quite a complex problem to solve, and it's not a magic formula when you can one day do something and everything changes. I think it's a very gradual process, and I think as a regulator and policy setter, we are trying to do it step by step, right? So we start from quite brief and quite ambiguous, in my opinion, regulation. And when we go to the Dear CEO letters, right, we made analysis and we published it and made the awareness of that. And probably the next step would be, in some sort of way, more guidance. But at the same time, keep as this supervisor to keep in touch with the market. It could be in different formats, in formats like this one, right, where everyone gathers and we work in fintechs and we are responsible for risk management. But as well in our supervisory processes, when we see something in that particular firm, which we don't see as a good practice, and making sure that it's corrected. So I think it's a gradual error. And there was an idea that we need different regulation for different size of company. It sounds good on paper, but as proportionality sounds good on paper, a risk-based approach sounds good on paper, but when you try to implement it in practice, when do you decide when the company is startup and when it's mature? Maybe the company is like, I don't know, it was established like 1 year ago, or it has 10 employees, it has like, I don't know, 100 million of payment volumes. Is it mature? Okay, but how do you decide when there is the threshold which should you decide that it's a big company, it has other regulation and more strict regulation or not? It's hard to implement in practice, I think. So, but it's good for debate, I think.
Actually, it's already in a law. There's very small company, medium, and large in Lithuanian law. We can use the same, just add a little bit about financial streams inside the company.
But in practice, and when you have law and lawyers, when it's, everything is debatable, everything can be, revoked in a court. It's very many issues in place. It's not, so, yeah.
So girls, what do you think? Would it be easier for risk management if we had such a split, small, medium, and bigger company with risk management, or it's still gonna be complicated?
Maybe a comment from internal auditor side. We all agree here that we lack kind of mandatory regulations in terms of risk management. And when we have the internal audit and internal auditors put some findings in terms of risk management, usually institutions and especially CEOs challenges these findings and they say, look, where is it written and is it mandatory? If not, why it is a finding? So that's kind of very tricky position for internal auditor.
Well, I think it's tricky for everyone because, as we said, it's not very much regulated, right? We need to be creative, and sometimes creativity comes with cost. What do you think, Andres? Do you agree that we need to communicate more and give more guidance and, I don't know, maybe from regulators, from the market participant, from Fintech Hub?
Oh, it works, okay. Yes.
Brief answer.
That is the answer to
well,
anything? No? Okay. I think if we're talking about, sometimes I was thinking to the dilemma about root cause of these issues which are related to risk management overall and in the ML area. I was thinking like an dilemma of chicken and egg. But is it really this kind of dilemma? What do you think?
Is it a chicken and egg dilemma?
Yeah. Is it related to this issue? I would say no. We all know the root cause of this, yes? And what is the root cause? What do you think? 3 words. 3 letters, sorry. ML? Is it ML?
No.
Itself, no. But I think we implemented ML, and we forgot about that ML risk management should be a part of overall risk management, yes? And this is the main issue. We concentrated so much on one specific risk, and we forgot that it is a part of everything, of all risk management. And that's why it's so, I would not agree that it's so regulated and everything is clear and everybody understand how and what to do. But itself, it's better regulated than a main risk management area. And this is, I would say, these 2 things, a few years ago, they started their journey separately. And this is the main issue looking from my perspective, because we concentrate so much on this specific area. It is important, it is very complicated and so on, but itself, we should not forget about the whole system. And this is root cause, I would say.
Totally agree with you. I will turn to audience. Any question from you? Yeah.
If we weren't criminally liable for AML, we wouldn't focus this much on AML. I was saying that the reason why the risks are so concentrated on the AML is because the liability is different. Right, it's like sure, there are many risks, and I'm sure that, we would love to think about all of the potential risks, employ all of these people, outsource it to different risk management companies, but at the end of the day, we prioritize. So if, AML risk is a big risk, it's a risk that puts people at danger. People need to look, if they're not money laundering, if they're not doing things that might make them criminally liable, therefore the attention automatically shifts, but at least in my opinion. Now, all the other risks, sure, we will take them into consideration, but it's always about cost and benefit. So if after assessing all of these other risks and after going through all of these procedures, you see that it's enough to do it, the number of times that the legislator allows you to do it, that's it. Best practices, what if me doing best practices costs, 3-10 times more than just doing what the legislator asks us to do? We'll almost always do what the legislator asks us to do and focus on AML. Sorry, just being the devil's advocate.
Okay, thank you. Yeah, you want to reply?
Yeah. I do want to comment that because I am of different opinion, actually. I think it's like when you get a driver's license, you are responsible to keep on the rules. You don't go through the red light and you don't say, I prioritize speed limit, right? So I think I agree that the attention shifted to AML, but this is something that we need to correct together with the regulator. And I think a couple other solutions would help. We talk about the tone from the top. If we get the right people on the top, many things will start moving and the attention will be the right one. And I'm looking at the Bank of Lithuania because from my point of view, it's basically like they are hiring employees, right? When you hire an employee, you look at the personality. You're not only looking at technical things, but you're looking, will this person fit the role? Will this person be a leader, the right leader? So we need to make sure we have the right people on the top. And we do need more clarity on many things that Joanna mentioned and so on. Having more clarity will also inspire and motivate us to do better things.
Totally.
And let me add, if I could, just as you did, according to your note, you did your risk management and risk assessment. You decided that, okay, I should concentrate more on this because there is possibility to get more, bigger fines and etc. Yes, I think central bank is doing the same. They have limited resources, they have limited possibilities, and more control, as I could understand, from the international organizations. Moneyval, FADF, European Commission on this particular area, ML. And I would say that maybe that's why the reason, root cause why they're concentrating on itself. But if we want to understand why, what is the reason why we have no proper risk management system, we should understand a little bit wider. Global situation, and we should understand that itself we should not be afraid if we are logical and we're a logical company which understand its risk and so on. You should be afraid more on maybe other risks are a little bit more how to say, more disastrous, and maybe they could impact your business even more than possible fine or liability from ML area, I would say in this way.
Joanna, you wanted to say something?
Yeah, I just wanted to add, I've heard that people mention criminal liability. There's also a lot of focus on the supervisor and the actions of the supervisor. But I think what is also very relevant here is the management responsibility. And this area is actually undeveloped here in Lithuania. But I'm pretty sure that sooner or later we will have cases where there will be big failures because the risks were not managed. And then there will be a question of managers' liability. Because of claims from the customers, because of claims from someone else, the creditors, and then the managers will find themselves in a situation where they will take the personal responsibility for what happened in that company, or for what they did or maybe haven't done, although they should. So I think the very powerful tool is actually the management's responsibility if we want to enforce and raise awareness of what is happening in the business.
Totally agree. And, you know, it's very easy to take IML. Everybody talks about it and, you know, okay, saying that, yeah, LML area is the one we focus on. Now it's sanctions, and we forget all the rest somewhere there, right? But if you haven't done the homework and you haven't identified all the risks which your company can be vulnerable to, you will never know what you have to prioritize and what you need to focus on, I would say. So yes, we all learned the lessons with IML because it was all over the paper from, I don't know, 2013, maybe 2010, you know, all the collapses and stuff. But now I think it's time, and that's why we brought here that we need to start talking about the different risks. Outsourcing, for example, I think 3 out of 4 today mentioned outsourcing, at least, if I counted correctly, so it's important. We can build a bank, a neobank, without having a license and just joining different, you know, suppliers into one, so who controls that risk outsourcing? And I think it's very, very important to understand what risk outsourcing brings to us. And probably the next question goes, again, maybe related to outsourcing, and I would turn to Auditors Outsourcing. So you think it's easy for companies to evaluate the risk of outsourcing or not?
I think someone said at least they should try. Let's start with that. So, if we try, that's already the beginning. As I said in my presentation, the difficult part is actually grasping this entire regulatory requirement around outsourcing and not forgetting things. So having like a checklist or some kind of a tool with guidance, I think really helps. And you know, if you are small and you have little resources, I think it's okay to get help on that from the outside. But I think it's critical to find the owner in the company. Usually it's called outsourcing officer, and someone can really start digging into that. Having a tool in place, as I said, it helps. But yeah.
What about risk appetite for outsourcing risk or so on? How you find it? Can you elaborate it? What appetite you can have for outsourcing risk?
That's a difficult question. I think many fintech companies outsource their core banking system solutions, and usually that's like, okay, if they down, what do we do? You know, having an exit strategy in place could help, but how many have exit strategy in place? I don't know, maybe Denas found, but there's little practice in that. So I think that needs to get going. I see some companies tend to be creative. They have at least some agreements with other core banking systems, or they hold on to the old core banking system and then they try to be creative on that side. But it will always be a high risk. It will always be a significant outsourcing. That's why it's required to go through thorough risk assessment process at least once a year.
If I may add, usually we hear from our clients that they say, look, this service provider is widely used in the market. Why do we need to conduct risk assessment? And it's kind of accepted and approved by the Bank of Lithuania. But to be honest, none of the service providers is kind of approved by the Bank of Lithuania, and still.
Do you approve some service providers?
Well, I'm not supervising actually outsourcing, but no, that would be quite strange approach to have a list of providers. But what can I say, at least from financial risk and other risk perspective about outsourcing? The red flag would be if there is a lot of outsourcing and basically 3 employees, huge volumes, payment volumes, and a lot of outsourcing agreements, indicator about maybe something is not related to Lithuania. This entity should be not in Lithuania, it's kind of empty shell. So at least from my perspective, that kind of data could show me that all the risks are in Lithuania, but benefits are outsourced somewhere else. Yeah.
So I think that I heard at least 3 indicators how you select somebody for inspection for risk management. Isn't it true? Gintautas, what about you? How you cope with outsourcing risks?
As for PCERA, we do almost everything in-house. We don't like to outsource. But looking at small fintechs, why they outsource? To start with mature processes is hard. It's easier to buy more efficient process outside and to implement inside your framework, especially when regulatory requirements are very high at process maturity level. You need to have proper data-driven, reviewed, controlled risk-assessed process. And that's really hard to start in a small startup company where you manage risk just by common sense, which is not so common. And by outsourcing, you reach out and get a proper process, but do you understand that process? Is it implemented properly into your other regulatory required processes? That's a question. And do you get enough information? Do you understand the information you're getting from your outsource? Can you use that information in your other assessments? Because just outsourcing them function and using the output without inputting that information into other data and company management decision streams, it's not enough. Because if you compartmentalize us and do in silos, it's not working. You need to see the full picture. And to see a full picture with a handful of people in small company, it's really hard. That's why we are talking about this, because regulatory requirements are for very mature processes. Fintech starting with 10 people, they cannot jump start into the 4th or 5th level of process maturity. And this gap creates a lot of problems of people lacking to do the proper regulatory requirement processes, the outsourcing understanding and what it does inside the company and how to reach that maturity level. So I suggest we should talk about how to help companies to implement mature processes inside to reach required regulatory requirements for those processes and be compliant. And how this connects to outsourcing and how this connects to such a difficult process as risk management. Because if you're a small company, you know almost everything by hand and you focus only on what hurts you at the moment. But you are just handling the common sense and you are too small, you're flying under the radar from the hackers or something. But then you grow, those small risks become the butterflies inside your company that can just expose you to a certain risk which can kill your company.
So can we help those small companies who just starting their journey with giving more guidance on our expectations from?
Yes, and that's why we need definitions, because then they will understand and then we will be autonomous to navigate in this difficult space. Because taking this framework and implementing into 10-person organization, you will have check marks of documentation, check mark of required points, but not fully working framework which allows you to manage those risks. And in small organizations, those risks are not substantial to hurt you or to influence the financial system. But learning to understand and what to do after what in a company which is growing, that's another discussion.
Yeah, probably that brings me to the question that we need to have right people who has this big view, big picture at top, and then sends it down, develops the juniors, helps them to grow and understand everything, and only by this we can move forward and to achieve the quality. Oh, so many questions. I'm happy. Go ahead.
So first of all, thank you very much for the presentations. Before, I thought it's going to be a very abstract discussion about risk. Myself as a risk manager, I could tell that you did your homework well and you got to the bone. And the second thing is to the gentleman, I guess, sitting there, who said, why do you need risk management? It's because it supports the business. So traditionally, it's aligned to the business strategy. So you cannot have risk management apart from it. This would be the methodology to follow. And the question to you is how you see risk management from regulatory perspective and business. Because there are two approaches. You can go to rule-based approach, right, where you say exactly what you need to do, or you can have a risk-based approach, where you identify your risk, you understand it's inherent to the business, you manage it. Or the third option would be, do you think it's a combination of that? So regulator is happy because you have all the processes in place, but at the same time, you have a common sense to identify risk, to classify it to the appropriate size, and then to manage.
Wow, good question. I love it. Who wants to start? Okay.
Right, yeah, indeed, good question. I think it's the third option as well as my slide. I think the second one where I say some risks are regulated, some are not. And those which are regulated, you have a lot of regulation. For instance, if you were a bank and you have indeed prudential supervision, then if you read the Basel III, it's 1,450 pages, and you have to implement that. So yeah, I don't know if you want in fintechs to have regulation which has 1,400 pages. It would be a headache. So I think it's combination of both. And indeed, historically speaking, AML was important, Prudential important, op risk, IT important, but what we see nowadays especially, right? Financial risks is hard to set the rules in which are detailed how to manage it. It's usually done by CFO, and these are now materializing. Capital is hard to raise, interest rates are high, so liquidity is hard, it's low now, so this is important as well, which is less regulated. You have capital requirements, but you don't have liquidity buffers like in banks. So yeah.
And one actually very interesting point about regulated risks, you cannot how to measure them without implementing controls first. And you cannot, how to say, feel them before you implement, and you measure only after you implement controls, and you try to make the controls more efficient to have residual risk much smaller or into the risk appetite area. And that's not mentioned in regulation, but actually it's a fun part of regulation.
If I maybe just add, I think it's clear that we need both the principles and the rules, but I think what is even more important is that we, first of all, have clarity of what is expected, and only then we have a survey where we can, respond something positive. So I think the clarity is more important, and there can be different ways, and perhaps it should be different ways how to achieve that.
Just to put the cherry on the top, I like the term when people talk about risk management as a business enabler. I think that is a really great approach. And we see that the opportunities for risk management to really become innovative and improve the business is great. If we just compare a business plan without input from risk management and a business plan with a solid input from risk management, I would bet on a business plan with solid risk management. We see that innovation really also helps us. Like, for example, we have, if we look back years ago, how client identification was done, and then all of a sudden we are able to do it remotely. I mean, that is a great way to improve risk management and be innovative. And I think now with artificial intelligence, we all have other opportunities.
And that's a very good point, actually. Then you'd have new regulations, new ways of doing business, and then how to convert those business processes into the IT and data. We need a lot of translations. And these discussions really help, because regulator releases policy, it goes to our own national law. It loses certain things or gets an additional one. Then to translate into our business language, into the business processes, we can be lost in translation again. And then you need to translate that into the IT language. And again, you have a certain loss, and then you can compare after 2 translations, you have IT, automated processes, doing risk management, measuring risk management, and regulator comes, he speaks in 2 languages far away from an actual implementation, and then you have a conflict where you need to have 2 translators talking together. So that's why it's really important to have creation of regulation together with business and data IT guys who will tell, yes, it's possible to implement efficiently enough in nowadays. Because if you have separate cases, case by case, you can do an individual risk assessment with a paper in front of you with all the small details gathered manually, but then you go to the huge, big fintechs banks, you do that data way. And how to join those 2, regulation and data way, that's really, really interesting challenge.
I bet it's interesting, and I think this is where we have the great managers, CEOs, and other personnel who help us to translate from one language to another. And yet I'm going to the next question. Yeah, proszę.
Hi. So 1 comment, 2 questions. 1 comment I wanted to make is that I feel lots of sympathy for those well-run fintechs with almost 0 or close to 0 revenue who have very well documented risk management strategy, processes, procedures, in some cases even better than big strategic infrastructure companies in Lithuania. So solely because they have regulation, because we have lots of Bank of Lithuania requirements, etc. And and how much risk can you really create with 0 revenue and 0 clients, right? So the risk management becomes like a more, path towards the actual business. But my 2 questions are, I spoke to my colleague in Taiwan, and we discussed about the risk management frameworks. I shared that UK framework we Bank of Lithuania used for assessment. And she said, well, that's strange, because in Taiwan, we simply made COSRM as mandatory framework for financial public sector, and everybody uses this framework, and it's easy to assess. So my first question to Dan, maybe to you, would be, would Lithuania consider adopting at law level 1 framework and apply it consistently? And my second question is, I went myself to Baltic Institute Corporate Governance Training, 6 days for board members, how to be a good board member. And I feel we really need these trainings for our fintech board members and shareholders who act as board members to really understand what is it, to have a good well-run fintech company and how much it costs, right? Because it's not 350,000 euros initial capital, it's much more than that. So would anyone consider preparing this set of training to, you know, make that maturity level at the top higher?
Thank you. So Denas, first question is about the Kosovo.
First, I will answer to a second question. I think that's a good idea. As well, it would be a good idea for companies which are in the licensing process to see how their financial projection doesn't make sense. So yeah, speaking about the first one, I think at this stage we don't really care which risk management standard you use. We use that. It can be debatable why this one, not our. I think from a policy perspective, I don't know if we need to say that this one and that's it, because it's always will be a question, why not that one? Why not that one? And we don't want that question. As long as it is implemented and it makes sense to your business model or to your business, maybe it's historically, it comes from a group level. You don't want, if it's large business at a group level, it uses one framework. Why should we impose, we are such a small market, why should impose that one? So we have to be flexible in that regard. However, in future, it seems that we, as I was talking, it's step by step, we will go to a more detailed regulation in that regard. We have PSD3, right, coming, which is EBA, maybe mandated to develop some guidelines, but we will see the proposal, how it goes. So we are in the transitioning period. We have DORA for operational risk and IT risk. So a lot of changes is coming, and we don't want to make quick decisions now. So yeah.
Good answer. So what about training? Sorry.
No, I was just joking that perhaps it's a good topic for our next event, but it's really a very good thought, and I kind of tend to think the same, that we have to educate the managers, and the problem now is that they are taking too much risk because they don't understand. So, and it's very powerful if you think about that, because if every manager is well educated, everyone who sits on the board takes their duties and responsibilities seriously, they would definitely start thinking about risks for many reasons. For success of the business, for financial reasons and whatnot. So I don't know, maybe there could be a way to prescribe those trainings to the managers in a way that doctors prescribe medicine. That could be one of the ideas to go.
I would say yes. About trainings, I think it's normal practice, ML trainings for management, so we all know. I was participating in few trainings for board members, and I would say it's just use your brains. Use your brains and be careful. I don't know. I would say my impression is if you're passing central bank interviewing process, you should have something in your brains. And to have trainings, of course, but I would say that good ideas from EBA, European Banking Association, that, for example, that after you are, prohibited wording, ML, yes, when you implementing your EBRA results must be published, not published, but information about your EBRA process and so on must be provided to your organization. It's like trainings about EBRA results, action plan, and so on. I would say this is more from my from my experience, I would say the biggest problems are issues, not education of board members itself, board member themselves, but maybe that they are sometimes they are alone with the knowledge, and of course the stone from the top should go and so on. But as we discussed, I think we should provide more trainings to the high management about risks, how manage risks, how to understand these risks, and why, and based on what they are taking decision to take one or another level of risks. I would say it's not, and maybe not so concentrate on the maybe board members itself, because I think all management is very important, and I would say that owners of the risks are the most important people in risk management area. This is, yeah.
If I may add my thought here as well as a cherry. So I totally agree with Andres that we need to train, and training is important to all levels, right? So if you have your eyes wide open, you will understand all the risks, and the training will give you more risks, right? But if you are one who has, have jumped through several entities for half a year or a year, in every entity, one day you will see, okay, I'm ready to be a CEO, chief compliance officer or a board member, right? And I have seen only maybe one or two bushes in the forest. But as long as you go deeper, you will see how many risks there are, and, and you will have your eyes more open. And that kind of trainings, I believe there are bunch of providers and lawyers and different consultants who have that training, but it should come from the person itself. He wants or he needs to want to have that training. He needs to be with integrity with himself, and saying, okay, I am in the industry which is regulated, which is complicated, which is interesting maybe, that's why I'm here, right? And if I want to be here, not selling apples on the market, I need to understand why it is so complicated and what I need to do to help it to grow. So I believe that trainings are the crucial thing.
May I add something? The best answers to the best thing and answers which I'm receiving as consultant when I'm doing EBRAS is how you ensure the level of competence of people who are involved in some specific positions. Answers are perfect. Like, he's working in this area for 20 years. Is it, could be? Yeah, maybe. We asking some questions. Who asking what questions? Nobody knows, and so on. So if organize this, if to put this something like this into the internal documentation or in legal requirements, it will be clear for everybody that you are employing person with good enough knowledge, understanding of risks and so on, and you avoid many, and you could have a chance to avoid many issues which are related to the lack of knowledge for board members and management.
Did we answer? Okay. Any last question? Anyone? Yeah.
Thank you. Hello. Actually, it's not exactly a question, it's more like a comment. First of all, I would like to thank you for this event, for selecting this topic, because I think it's really important to have more meetings, more events, more trainings related to risk management. Especially for smaller fintechs, it would be a lot more helpful to get more information, from example, from Bank of Lithuania, to receive like more explanations, maybe even trainings concentrating on how Bank of Lithuania wants us to manage the risks. Because, well, big companies, they can attract risk managers with high experience, with trainings, with knowledge. For fintechs, well, it's complicated. And for example, personally myself, when I search for the trainings in this area, it's really complicated to find. For example, in Lithuania, it's complicated. In AML, I can find plenty. In risk management, there is really not so much. And for fintechs, if we would have such events and such trainings, it would be really a huge help. And another point I would want to comment, someone mentioned list of pre-approved outsourcing vendors. Well, actually for small fintechs, I think this would be a good idea if Bank of Lithuania would have such list. Because, you know, small fintech basically selects the vendor who is active on the market, who has many other customers. And sometimes we are in the position that we need to sign the contract. They provide us the contract. And in the contract, in our opinion, not all provisions of Bank of Lithuania are in the contract. And we start to argue and we say, no, we follow ABA guidelines and everything is okay. We are not fully sure. So in which cases we are like submitting, or we are not signing the contract, or we will submitting to Bank of Lithuania and really not being sure if all the requirements are met. So from our perspective, actually, list of approved outsourcing companies would be good. Thank you.
And it's good business opportunity for Bank of Lithuania, yes?
So I'll just say something about the training, because I had the same issue when I was trying to find a qualification that would be relevant. At the same time, they are very expensive, right? So you want the right quality for the right cost. So in Europe, we have Federation of European Risk Managers. So they have RIMAC qualification, which starts at 350, which is not very expensive, I would say, but you are still recognized and you get a certificate. And this is the cheapest certificate, I would say, and at the same time, the most applicable to the market because it's EU. The other thing is that now we are reestablishing the Risk Management Association in Vilnius, in Lithuania. I know that we have some members here as well. So we'll be trying to do this as well, but it might take some time to pick it up, but we're definitely looking into this.
Thank you. So I think we are finished. Time is up. We kindly invite you to join for tea and coffee. If you have any question today or tomorrow or even at night at 2 a.m. you wake up and you have this question popping in your mind, feel free to contact us on LinkedIn or everywhere else. And yeah, thank you once again. Enjoy the evening.